listen-only mode.
Good evening and a very warm welcome to all of you. I am Saranya Shetty, Manager Corporate Communications and Investor Relations at India Ratings and your host for this webinar. Firstly, I want to thank all of you for taking the time out to join us for today's webinar. As you all are aware, we are here to discuss the steel sector outlook which was released yesterday. Our presenter for today is Nidhi Singh, Senior Analyst for the sector. Before we kickstart the session, there are a few housekeeping announcements. The webinar, as you must be aware, is a very interactive platform. So we would encourage you to please post questions for our presenter. You can post a question through the dialog box on your screen. Once we are done with the presentation, we'll start taking the questions in the Q&A round. So without much ado, I'd like to hand over the session to Nidhi. Over to you, Nidhi.
Thanks, Saranya. Hello. Good afternoon, everybody. I would take you through the steel outlook that we have, India Ratings steel outlook for domestic steel producers. We can, before I go to the detailed presentation, I would briefly like to take you through the agenda items, which are, I would first be presenting the India Ratings outlook on the first slide for FY16. Then we'll be discussing the key issues that are surrounding this industry. We would then be taking up the review of the ratings that we have conducted in 2014. At the end, we would like to cover how and what circumstances, under what circumstances we'll be changing the outlook to stable. So in the next slide, slide number 1, here what we have, India Rating has actually maintained negative rating outlook for this sector for 2015-16. We may feel that the sector is actually may have bottomed out, and with positive investment sentiments flowing in the country, but this sector is actually a lot governed by global scenario, and the global volatility and overcapacity that has been there has made us, in view of that, we feel that the industry will continue to face challenges during this year as well. So despite a domestic demand revival, we expect that the steel producers will continue to face pressure over the pricing front, and this I would again say that 49% was the growth in imports that we saw from April to November 14 period, which had to a lot of extent restricted the domestic players from increasing the steel prices. So we expect the trend to continue in this year as well. And then of course the additional capacity that is expected to get operational during this year, our domestic steel producers have been adding, few of the major steel producers are in line to add to some capacity in this sector, which will again restrain the steel prices. So here in the graph you can see what our rating outlook has been. As the last year also we had a negative rating outlook. So almost 20% of the issuers are on the negative rating outlook, and approximately 80% are over the stable outlook. So now we can go forward and discuss what are the key issues which are surrounding the industry and our domestic steel producers. So we do expect that with our better GDP outlook that we have for FY16, the demand offtake will be there. But of course, the demand outlook that we have would be gradual. The steel demand outlook, the demand growth rate will be gradual. Before we even discuss how will it go ahead, the demand of steel, we can summarize what happened in 2014. The pace of growth was so sluggish that I mean even our GDP forecast for FY15 sorry, is 5.6%, and we saw that the crude steel production growth was at 2.5% from April to November of 2014 to 55.29 million ton, sorry, and the consumption actually was only at 1.3%. to that in volume terms, it was 48.62 million tons. So the IIP numbers continued to fluctuate. We saw a recovery at the end of the year, and the automobile sector also showed recovery during the end. So, and the policy paralysis kept the construction sector also very low. But in FY16, we expect a GDP of 6.5%, which would be majorly backed by services and industry. Industry sector is expected to pick up at 6.5% growth, which is a major driver for steel demand also. So we expect, basing on industry growth, the steel demand outlook to be good. But of course, the softening of rate of interest, which has already happened by 25 basis point, will boost the investment sentiments in the country. And India Rating has an estimate of 75 basis point reduction in repo by before FY16 end of FY16. So that would again revive the automobile and engineering consumption. So all in all, we expect a gradual steel demand. The steel demand would actually start coming in post-union budget of FY15-16, with the government actually working towards removing the bottlenecks that are hindering the sector growth, and the government quite positive about how to revive the infrastructure and working on the $12 trillion plan that they have in the 12th plan, which we have already seen. So we expect the steel consumption to be somewhere between 5.5 to 6% in FY16, backed by the GDP growth. And since there's a high correlation between the GDP growth and the steel consumption, we expect the consumption to range in that, to figure in that range. And we can actually go to the next slide, where now the next issue that surrounds the industry majorly is the steel prices. As I said before, that the industry is majorly governed by global factors. So in this slide, you can see the trend that has been there in global steel production, the Chinese steel production, and the Indian contribution in the global steel production. So we can very well see that China is a major contributor in the total production. Not only that, China has also been, for the past 2-3 years, for quite some time, it has been the major consumer also. However, there has been a lot of change happening in Chinese consumption pattern. China has moved from a investment-driven economy to a consumer-driven, consumption-driven economy, because of which we have seen a lot of contraction in the Chinese steel consumption. As per the China Iron and Steel Association, China's steel consumption contracted on year-on basis to 0.3% to 500 million tons during January to August 2014 period. So this has caused a lot of oversupply in the industry. China actually usually exports somewhere around 5% of the steel output. However, this has changed over the last 2 years, and the industry data says that China also has exported somewhere around 94 million ton in 2014. So because of this change in the consumption pattern in the China, we have seen a lot of oversupply of steel, which has led to a substantial decline in the steel prices. And even the import-export that we have seen, in the next slide, we can see the graph which shows how the import and export pattern for Indian economy has also changed. We can see that the import has risen, and the Indian steel, the cost of production of Chinese steel is low. So the Indian steel producers were forced in 2014 to keep the prices low, because of the cheap imports coming in. So we expect even in 2000, because of the whole dynamics in the industry still changing, we expect the imports to continue to restrain the domestic steel producers from increasing the steel prices, and this will hence keep the expansion possibility of any expansion in the profits minimal. And we can of course see even later how the raw material prices will be faring, but we can even see that despite proper the revival in the domestic steel consumption will again be will not be contributing much towards steel price increase, because there is a lot of capacity addition happening in India as well. We expect a 12 to 14 million ton addition in capacity by the major steel producers in India during this year, so which will again bring down the prices. The capacity utilization in 2014 has been below 80%. So, and we expect the capacity overcapacity in India also to continue for another 1 to 2 years. The best way out would be to have more of value-added steels and to focus on cost so as to fight the any prolonged price recovery which might be there and which we can see during this year. So in the next slide, what we can see is the steel prices trend that has happened from March 2014. We see that the steel prices have gone down, and that has been the trend in India. The next slide, we will now look at the raw material prices, which affect the next key issue is the average raw material prices. The average raw material prices are expected to remain low across the globe. Iron ore outlook for India has, if we want to sum up for 2013-14, India produced about India has produced about 152 million tons of iron ore. Exported about 14.4 million tons of iron ore, and the domestic consumption of iron ore during the year 2013-14 was about 104 million ton. However, in 2014 to 15, due to regulatory curbs, iron ore production is expected to reduce to 140 million tons. The mining bans that were put by the Apex Court in Karnataka and Goa over the past 4 years have actually hit the supply in India, and in 2014 the problem got aggravated with the court's order in states like Odisha and Jharkhand, which are actually the major major iron ore producers. The Karnataka, the mining ban in 2011, which was put, was opened in 2013. However, a cap of 30 million tons was put for the year. In 2014, Supreme Court though lifted the iron ore mining in Goa with a clause, but a clause was put for fresh leases, and even a 20 million ton cap was put. So, and the restrictions that were put in Odisha and Jharkhand have actually caused, we saw because of that, a lot of major steel producers going for imports, though despite having captive linkages. Those small renewals have happened, but since there is still a lot of the role of state government is still quite high, they have actually delayed the renewals on time, and they are still actually holding back the renewals. Because of this, there's a lot of non-availability or low availability of iron ore prices. The smaller players continue to suffer. So we do expect good amount of structural reforms coming in this sector in the medium term. And with government planning to go for modifications in the Mines and Minerals Development Regulation Act, we may see proper raw material linkages being made available to the steel producers. And we will also see the the iron ore availability improving as NMDC wants to is moving for increasing in their capacity. They are actually moving from 30 million ton per annum to 65 million ton by 2018-19, and the agenda is to take the figure to 100 million ton per annum by 2020-21. So we do expect the policy reforms to come by the medium term and the iron ore availability to improve. Though in the global scenario, the way the iron ore pricing has been, an increase in the iron ore prices is quite unlikely. On the coking coal front, we may the fall in the coking coal prices was actually proved to be good for the domestic steel producers, which were suffering for quite some time from pressures from pricing end and even from lack of domestic demand drivers. So it was actually a breather to them. And we do not expect a rapid price hike in coking coal across globe, as there's a lot of oversupply already there, and there's a lot of supply tightening is required in order to firm up the coking coal prices. So we do expect the coking coal prices to remain low, and China, which actually consumes about 60% of the world's coking coal, has, as I said, has gone for a lower consumption levels, and India actually has only 14% share in imports of coking coal. So India's revival, demand revival, may not be good enough to push the coking coal prices, and the China, which was a major consumer, going down. We do not expect the coking coal prices to get a significant hike. So all in all, the pricing will continue to favor the domestic steel producers. In the next slide, you can see, all together on the above backdrop, what we have discussed so far, we expect the margins for the steel producers to remain modest. The competition with import actually will continue in this year, and the pricing will continue to be low. The cost of production of Chinese players, as I said previously, when compared to Indian producers, is low. So this will again keep the Indian producers to keep a check and not hike the prices. And the capacity addition will again keep the prices low. Then currency depreciation, if any, would wash off the benefit of low coking coal prices. And then as the pricing will not change, the steel producers will not be in a capacity to immediately change the prices, steel prices, so EBITDA margins would again suffer. So all in all, the margins are expected to be modest during this year, despite a recovery in the demand. In the next slide, we'll briefly discuss how the credit profile of the steel producers is and is going to be. We see that most of the steel producers are highly leveraged on account of the capex that they have undertaken, and with addition of working capital requirement, as the capex has started becoming operational, all the capacity additions have become operational, there's an increased working capital requirement. Because of these two factors, the debt levels have increased. However, due to the lack of demand drivers, the profitability has remained moderate. all this over the past 2-3 years has caused the leverage to increase to quite a level, to a substantial level, and in addition to this, the small steel producers are also impacted on tight liquidity as they are hit on the margin front also, and their low they do not have the capacity to increase the pricing, as well as the economies of scale have not is not to their benefit. So there even the credit offtake has been very low for this industry for the last year. So these factors have left low headroom in the rating. We do not see the credit profile to improve in FY16. Even if the recovery is there, it would be very marginal, as the EBITDA margins will continue to be modest, and the leverage will continue to increase with working capital requirements increasing, and the capex commitments that have been made by the producers. Though the softening of interest rate might support the interest coverage, however, with working capital requirements increasing, the interest payments will also increase. It will, of course, only the softening of interest rate will support the interest coverage. So in the last slide, I would like to, in the next slide, I would like to briefly cover what has been our actions on the entities rated by us. We see that the 81% of the entities are on stable outlook. However, in this 81%, 67% are below sub-investment grades, which factor the weak credit quality that we have. They are highly leveraged, and they even faced liquidity issues. So we see that 67% have been maintained at sub-investment grade out of 81%. 19% have figured on negative rating outlook. There has been a constant time overrun on the ongoing capex. We saw that a lot of steel producers have shelved their expansion plans because of missing demand drivers. Then even their credit metrics were at elevated levels, as I explained in the previous slide. And there were a lot of regulatory uncertainties which have, because of which we have maintained a negative rating outlook for these entities. So what would make us change the outlook back to stable is when we see a substantial domestic market performance, which is actually driven by the long-term growth potential of the country, and or a sustained improvement in the global steel prices due to any market balance coming in. These two factors, if they actually put a significant improvement in the prices and profitability, and also improve the credit profile, we may also consider a stable rating outlook change. So all in all, this was from my side. I'm open to questions. Would request any question that is there from your end.
All right, thank you, Nidhi, for that presentation. We do have questions here. I would also request all of you to post more questions that you would have. The first one here is from Mr. Vikas Kulkarni. Are there any specific grades of steel being imported?
Yeah, actually, what I said previously is China has been exporting. This year we saw even the alloy steel under the they have exported alloy steel, and that is expected to come down, though that even in TMT we had the export, which was not exported to India, which was not the trend previously. So that is one thing which was not previously there and has hampered Indian domestic producers.
Okay, the next question is from Rashi Varma. What would be the major problems faced by Indian iron and steel industry?
major problems, as I said in the in my presentation, the problems will be on the pricing front majorly. We do expect the mining reforms to come in and the iron ore pricing not to be a major factor. However, the steel prices will continue to be low, which will be affecting the margins of the domestic steel producers.
Would you want to elaborate on that? Are there any other factors as well?
See, the factors, as I said, the steel pricing is again influenced by a lot of other things, like, of course, the global factors that are playing in and the increase in domestic capacity also. So we expect the major steel producers to continue adding capex as they are in a capacity to do so. However, the smaller producers will still face problems as they are not in a capacity to increase the pricing, and of course the liquidity is tighter for them. So if you see the major steel producers, they have the comfort, like Tata and JSW, they have the comfort of liquidity with them, but even the leverage level is high for most of them. So they will continue to face pressure on how to bring down the leverage level, and but of course the long-term potential being there in the industry, the long-term sentiments actually, we do have the long-term prospects are good. So in those lines they will continue to add capex. So
Okay.
pricing actually I consider would be the major problem.
Okay, the follow-on question here from Rashi Varma is, so can we say that shortage of metallurgical coal could also be a problem?
Actually, we might say that because of the increasing capacity that is becoming operational, we have pegged it at 12 to 14 million tons. However, the industry is still very optimistic. So we may say that we might have a shortage of metallurgical coal as well, but yeah, that can be said. But
Okay,
that would be majorly because of the increased capacity adding on.
All right. Another question here is from Mr. Vishal Gupta. What is the cost of production for Chinese steel and Russian steel, and what is the break-even on which they can sell the steel in India?
Actually, broadly putting it, the Chinese steel is still very low. The cost of production is very low. Russia is actually is right now undergoing their a change at their end, so we do not see any problems coming from that country to us. But of course, China's cost of production is very low, because of which the steel prices are kept low, and the prices that we saw during last year in this segment have even in October, when the with festive season, during the festive season where we see a price hike coming in, the producers were not able to match up. They had to keep the prices low at par with Chinese imports. So the cost of production, exactly to give you a figure, will be at this moment difficult for me, but of course it is lower than Indian steel cost of production.
Okay, the next question here is from Mr. Dilip Panchal. What happens if the Indian government increase import duty on steel?
That would actually change the scenario a bit, but I would say that it is not very easy to, and it might not happen very shortly. Only when the situation aggravates we can, because actually the producers have been trying to go for such a move from the government. They have been trying for such a move for quite some time, since in fact October, November itself. But such an action has not come from the government, and there could be various reasons on that. Such an action, of course, will improve the pricing scenario, but this cannot be seen until unless the pricing actually gets affected severely in the short run.
Okay, the question here is from Mr. Gaurav Chaturvedi. Will distressed steel companies revive in this year?
As I said, that the major steel producers will continue to add capacity during this year as they have the liquidity support. But the leverage levels will actually, with the leverage levels, they will definitely register marginal improvement because of the raw material pricing remaining low. But that would be very marginal. We do not expect a major correction in the credit levels happening, and even we see that the RBI's latest movement for allowing even the existing debt to be restructured and not exactly classify as restructuring. This will definitely help them ease the pressure on the cash flow, but this will, of course, this will again take some time to come on paper, come on actually get implemented. So this might actually by the lenders somewhat ease the pressure, but yes, the distressed steel industry will only get a marginal benefit, and the stress will continue for this year. But with the gradual demand picking up by the end of the year, of course, we can say that the things will turn out to be decent, and we may even have a better visibility on how the international steel industry is behaving if actually the Chinese demand gets consolidated and a lot of steel producers, the oversupply gets tightened. We will be in a better position maybe at the end of the year.
All right. Another question here is from Mr. Lalaram Singh. I'm not sure if we would have details of this. However, Nidhi, this one's, can you give a breakdown of steel consumption in India by domestically manufactured and imported steel? Hasn't currency depreciation hampered imports?
Yeah, as you said, I may not have exact data or as such. The currency depreciation, we saw that the imports exactly didn't come down. In fact, the imports actually have increased. So the currency depreciation didn't actually affect the imports, and as somebody has put that an import duty actually might affect the import. Until unless, because actually the currency substantial currency depreciation might of course affect the import, but up till now it has not happened too much to a lot of extent, as we see a lot of exports going from China, and even because there was a free trade agreement from Japan, we saw even a lot of exports coming from them. So that might reduce as the tenor is ending shortly. So the exports from Japan and Korea that was flowing in India might reduce shortly, but the currency depreciation has not affected the imports quite much, a lot of.
Okay, the next question here is from Mr. Indraneel Pandit. However, I believe we have answered this question in the previous discussion that we had. This one's, are there any tariff barriers currently to stem imports of steel into India? If not, are there any barriers expected to come in? Do you want to elaborate further on this, or maybe?
I think I have answered that question, that this might not come very shortly. because the government is in a is in a mode to first lay down remove the bottlenecks. If a revival in the in domestic front does not still boost up the prices, then and the prices face a lot of pressure, then there could be such such a step coming in. But I don't think that it's in the short run we expect any such import duty coming in.
Okay, another question is from Mr. Gaurav Chaturvedi. What will be steel industry's contribution in GDP of India during next year?
Steel industry all in all has contributed 2% of the GDP. So we expect the same levels to actually the steel consumption is majorly driven by construction sector, which forms 60 to 63% of the steel consumption. And with the construction sentiments becoming strong, we expect the GDP actually contribution is from the steel industry has been 2%. So we expect somewhere around the same level.
All right, this one's from Mr. Vishal Gupta. Geography-wise, which Indian players are best placed as transportation cost is high?
Actually, you're talking about Indian domestic steel producers. I believe JSW is well placed because of its proximity with the rail and even I think we can say JSW as of now.
Right.
With the freight cost, actually the cost of the admin and freight and other costs for JSW is lesser than the other major steel producers. So I would place JSW Steel if you want exactly one name.
Okay, there's another question from Mr. Chaturvedi. Is M&A a better option for medium-sized steel companies in order to reduce the debt, or is there any other solution?
For medium-sized steel industries, actually the option left is M&A, and we do have a lot of media coverage for few of the entities trying for such a move. But see, this industry as such has become so highly leveraged. It is on those front to establish viability will be a question until unless, as I said, the RBI's move could provide some respite and we actually work out the financial viability. Then, of course, a better player which has lower levels of leverage and is very maybe a better group as such could actually look out for such a move in order to enhance capacity, and this will definitely, I feel that this will happen in the short run, not in the short run, maybe during this year, that some of these things might happen during this year as every major steel producer is gearing up for the long-term vision of getting a better steel capacity and encashing on the better outlook that India has at present.
Okay, and another one here is from Mr. Singh. Have you downgraded or upgraded any listed Indian steel company recently? The ones under our coverage?
Not a listed steel entity, no, we haven't. However, we have maintained a negative rating outlook for most of the steel producers, major steel producers that we are rating, and view on that will also continue during this year as we have maintained negative rating outlook for our entities. So with holding that view, we might see few downgrades also, but that's case-to-case basis. We'll take up that.
Okay. This is a question from Mr. M.B. Mahesh. Do you have a slide on the extent of capacity addition, public and private? Also, can you discuss the extent of delay on existing projects?
Yes, we don't have a slide at present to show it to you how the capacity addition will be happening. However, with the JPC has been very optimistic, and the figure given by them by FY16, 40 million tons of steel capacity would get added. But the way the trend has been so far, most of the producers had to shelve their capacity addition plan because of the missing drivers. Though the demand revival sentiments are there and it will pick up during this year, the pickup will be gradual, and as most of the capex that has the cash that has gone into the capex has not yielded results because of low demand in the past few years. So this has the balance sheet of the companies are not in a position to go ahead with a lot of capex even in future until unless they see the results from the previous capex flowing in. This is one point that I want to make. Secondly, to answer that question, how has the capex actually fared? That has also a bearing on the missing demand drivers, as I said, also has a bearing on the slow progress rate and the time overrun that has been there in the capex. We have seen a lot of time overrun. The steel capacity actually has almost doubled from FY17 to FY13. So in that rapid expansion, and already the balance sheets have become very leveraged, but of course the long-term sentiments are there, so there is a lot of urge to go ahead with the expansion, but the balance sheets are not supporting. So that's why the rate has been very slow, and we see that, of course, few of the major steel producers which are in a comfortable liquidity position will continue to add on, whereas the smaller producers will wait till they get the value out of the previously invested capex, and then when they are in a better position to go for a capex, they would go for that.
Okay, this question is from Mr. Chandra Bose. What will be the price change expected for cold rolled steel for FY16?
Price change, actually I have not exactly worked out for this cold rolled steel, but we expect actually the prices to remain low, and as I said previously, a better, of course, we may have a more addition of cold roll steel or other value added steel products in your portfolio in order to get a better margin, but all in all it will remain low. We don't I don't have as of now a proper, I can't give you that what would be the exact figure, but all in all it will remain low.
Okay. Have any of the companies announced any new capacity expansion in the next 2 years?
Most of the capacity announcements have been previous ones, because those capacity additions have not happened on time. The announcements have not been there. Of course, international players have also reiterated during this year that they are still positive and would like to enter into India once there's a clarity on policy and there's reform coming in. So that is, of course, I think that would come later at the fag end of FY16. So announcements exactly have not come in during the last year.
Okay, and This one's, do we have an outlook for stainless steel industry and pricing for FY16?
Pricing, as I said, separately for each category has, I will find it difficult to give it to you as of now. But of course the pricing will be low, and better inclusion, as I said previously, again I will repeat, value added steel more in your portfolio will definitely give you better margins.
Okay, this question's from Mr. Vishal Gupta. When you say that construction is 60 to 65% demand, is real estate also a part of that, and what share is of capex?
Sorry, the last line, last part of the question is not clear to me. But of course, construction, by construction I majorly mean railways, infrastructure, and yes, real estate is also a part of it. But infrastructure is a major part in that.
Okay, clarity on the question once we
Last
get it.
Part of the question is not very clear.
I would request Mr. Vishal Gupta to please mail us the question again. For now, capex means other companies use steel. That's what he meant.
Capex means?
What he's written is other companies which use steel for making machines.
For real estate, you mean to say? For real estate, the companies that are making machines, how has the capex fared? Is that the question, if I've got it right?
Mr. Vishal Gupta, could you please confirm if that's what you meant? No. Okay, that's not what he meant. What he's written is, like companies which use steel for making machines, plants, ships. So are they included in this 60-65%? Or maybe, Nidhi, if we're not very clear on the question here, probably we could answer it later offline. I would request Mr. Vishal Gupta to please send us an email on investor.services@indiaratings.co.in. We will take it up there. For now, these are all the questions that we've received. In case any one of you wants to post further questions, you may please do that. In the meanwhile, Nidhi, could I please request you to give us like few key points, 3 or 4 points that you would want all of us to look for in the sector in this financial year, which would, totally change things for the sector. So those key highlights, positive and negative.
Okay.
Yeah.
Okay, as I said, a major part of this industry is majorly governed by global factors. So negative would be any substantial oversupply or a lot of export coming in from these China, and with few economies expected which had actually shown some recovery in the last year and not doing well, as we see that US interest rates could increase and there could be again some volatility in emerging markets, and this could affect investments in India. So then the demand drivers will again of course be a bit there would be volatility in that also. We may not have the expected demand. So that could be one thing, how the global economy would fare, and then how will the pricing fare because of that. So that would be a negative for the industry. The positive could be that the global economy actually tightens supply in a medium term, which would give a better visibility on the pricing front, and which will affect the Indian industry also. And first point would be this. Then the second point, which the government might put in a cap on the imports that are flowing, and then the domestic producers can save themselves from the competition and encash on the better revival prospects that are there. So if these things happen, then we might see the top line increasing, improving, and which will give some good support to EBITDA. So then that would lead to a better recovery of the industry and the entities that are playing in, and their credit profile might also see some improvement.
All right, thank you so much for those thoughts, Nidhi. And I would especially like to thank all of you for your questions. You've made the session really interesting with all your questions. As you know, the Outlook is already uploaded on our website, which is www.indiaratings.co.in. You may also follow us on LinkedIn, Twitter, and Facebook for regular updates on the sector. Day after tomorrow, we have another webinar happening on the cement sector. So if you would require a copy of the presentation made today, I would request you to please send us an email on investor.services@indiaratings.co.in. And we'd also like to hear from you your feedback on today's presentations and what are the other topics that you'd like us to cover in future webinars. Thank you so much for joining us. Have a great day ahead. Thank you.